National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice. And on today's show, Index Annuities with industry index product expert, Sheryl Moore. And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist, Steve Savant. Well, welcome everyone to the Business Insurance Zone. I am Steve Savant, your host, and we're broadcasting live to a nationwide audience of producers and advisors right out of Fountain Hills, Arizona, home of America's largest fountain. And with me today and all this week and tomorrow is Sheryl Moore, industry expert and gun guru, goddess, icon of the insurance index world, princess of premium, Countess of Commission. Actually, not there. Probably went a little too far there. The little IMO language there. Welcome to the show again, Sheryl.
Thank you. I'm so modest. You're just embarrassing me, Steve.
Hey, listen, my resumes are to die for. You know, I mean, I just have stuff that I talk about. My guests, listen, I have some of the best on here, and you are the best in your field. If you missed any of our shows, Monday, Tuesday, and Wednesday, and you are a player in the annuity area, and you're a player in index annuity specific, you have to watch Mondays, Tuesdays, and Wednesday show. Hop out on our site, www.brokersalliance.com. As soon as you come to our homepage, you see a big red button, On Demand Video. Click it. It'll put you right into the archives. Don't miss a thing. And I recommend, by the way, I do. If you're seeing this show and you didn't see Monday, Tuesday, Wednesday, you may want to go back first. It's kind of a building block show, and that I think will really help you. And we talked a little bit about this in yesterday's show. We definitely got to figure out a way to have Sheryl back, and we're going to do mechanics on a whiteboard, 4x8. We're going to just break it out. We're going to draw this out on, and do a real good workshop on this on video, because everybody's saying, gosh, what you guys talk about is so good, but I'm more of a visual guy. I hear what you're saying, but sometimes it's hard to capture that in my imagination.
I agree, Steve. And just because these are some more complicated concepts, I will say until we do the whiteboard thing, I just wrote an article out on Producers Web, and if you go out there and follow me, I'd really appreciate it, because I've got the #1 spot that I'm gunning for. Look out, Lou Nason. But
wow, and I just want you to know that was a PR for Producers Web, and I hope that Dan is watching. So,
yeah.
Okay.
Well, the article is called Getting Your PhD in Indexed Interest Crediting, and it not only explains in simple layman's
part
terms.
2 to that other article you wrote?
No, it's that article. And there's actual visual charts that show how we calculate the index interest on the most common methods.
I personally read the article, commented on the site. And if you haven't read it yet, go out to producersweb.com. Oh my gosh, Dan, you owe me big. Producersweb.com, and go ahead and pull it down. It is to die for. It's excellent. I read the whole thing. As usual, I picked up things I didn't know again. Here we go.
Well, good.
Today, we're talking about index annuities. Okay, fine, fair enough. But you freaked me out 2 days ago when we said hardly anybody in the United States is annuitizing. The whole purpose of why we're buying this.
2%.
Less than 2%. Income riders now are making that's going to happen. Annuitization is going to happen more and more now because of that play. Now, we have income riders that you have to pay for. Some of them are up to 100 basis points, some of them down to 50 basis points, depends on what the spread is. I haven't seen anybody freebie. I don't know, maybe there are some frees out there. Are there?
2
freebies. Wow. So
but
no
be
charge.
careful about free.
Right, because maybe the rate's
Nothing
not
in
that
life
great.
is free. Exactly. They're subsidizing it some other way.
Well, let's talk about income now. People on certain other chassis that may or may not make this show today, they have to pay for their income riders, and they are only using watermark account values on their income. A lot of our index are already telling you the guarantee, what's it going to be over the accumulation period, and the income you're going to get for life off that number. Now, it may be better, but it's not going to be worth. Now, what's with that?
Well,
Going in.
You have to keep in mind that income riders, or GLWBs, Guaranteed Lifetime Withdrawal Benefits, originated in the VA space. And some of those product design features are going to be far different than what we have in the indexed annuity market, just because we're talking about a VA where the values can fluctuate up and down. And on an indexed annuity, they won't fluctuate as a result of market fluctuation. So some of those features are going to be different. But on the indexed annuity side, we have companies that will guarantee an increase on that shadow fund, or that benefit base is technically what it's called, where that value is only available in the event that you take your guaranteed lifetime income. You can't get it on cash surrender. You can't take it through
Right.
penalty freeze. But we do have companies that guarantee an annual rate on that value.
No, I'm so sorry to stop you there, but because this is going to be E&O land in the next 5 years, I promise you, I just want you to regurgitate what you just said.
Well,
because,
let me explain it.
Yeah,
in
because
a
I
little
think
scenario.
it's huge. It's huge.
Well, okay, we're talking about an index annuity. Let's say it's a 10-year product. I put $100,000 into the index annuity, and let's say for 10 straight years the S&P 500 goes down. Okay, so at the end of a 10-year period, my account value, the amount I'd get on surrender or death or through penalty freeze, is only going to be $100,000 plus my minimum guarantee. Okay, and based on a minimum guarantee of 87.5 at 3, which good luck finding that right now, is going to be $118,000 of cash value. Okay.
Okay.
But let's say I have an income rider on that product that guarantees a roll-up of, let's just say 7.2%. So we can use the rule of 72 and make it real simple. If there's a roll-up on that income rider that says, hey, we're going to credit 7.2% compound interest every year to this invisible value here every year, at the end of a 10-year period, our $100,000 is now what? $200,000.
Right.
Because of the rule of 72 saying it'll double at the end of a 10-year period.
Okay, can I stop you right there?
Yeah.
I just want to make sure everybody gets this. I have the annuity guarantee,
Which is
0.87, what did you say?
87.5 at 3%.
87.5
Plus our premiums paid.
at 3, that's a guarantee.
Yep.
Over on this other side, for the income issue, I have another number.
Yes,
And the number
absolutely.
you gave
and they're
was-
not the same. 200,000.
Okay, so it's double. In this case, it's double up. So here's the real money.
Yep.
Cash surrender. I could get to it any time. Worst scenario, I got zeros all the way out. Whatever my guarantee was,
Exactly.
I got 87.5 of that number, whatever that number is. That's it.
Right.
On this side, though, however, I have my income, so I could be in the case of Jesus, the roll up pushes me up to 200K for income only.
Right. You cannot get that on cash
Not in
surrender.
cash surrender, withdrawals, none of that. It has to
No.
be annuitized.
Right. Well, it's not annuitization, but it's duplicating the effects of annuitization.
Well, what do they use? If they don't use the word annuitization, Cheryl, then what are we calling it?
We just call it guaranteed lifetime income payments, or turning on the income under the rider.
Okay, now when we think about that, because we talked about, some people, charge for this up to 100 basis points. Some people charge
110.
110. Wow. 50 down to 50.
We actually have some
as
as low as 10 basis points.
wow.
But what you're talking about here is, what is the attractiveness of the rider? How rich is it? The more rich or the more advantageous benefits, the more expensive it's going to be. And that's no different than in the VA market. But those who would have lower roll-ups are probably going to have lower charges and vice versa. We even have some income riders where that $200,000 would be available on death, where traditionally it would not be.
Now, do I have to pay extra for that
Some of them-
benefit?
yeah, some of them you do.
So I might have to pay extra for the income rider. I might have to pay extra for a death benefit rider.
Exactly.
But it's on this other segregated number.
Right.
So, and again, we just got to do workshop because I wanted to draw all this out.
Yeah.
And we have some of this, our own proprietary drawing up, but I'd rather have Cheryl explain it once we have her back in. We're going to do the workshop and really let her just do her artistry on the whiteboard.
I've never done it, but we'll make it happen.
No, I just say, hey, it's time to join the land of the teaching and instructional tutorial. So, but my thought is I want them to make sure we all know the mechanical difference. And for those who might be watching us at our retail on the internet, again, at 2 different pots. Remember, every carrier is different.
And this is very, very important, Steve, because when I first started developing products in the VA space, I will tell you, if I had $1 for every time an agent called me and said, Cheryl, I'm in a competitive situation and the product I'm competing against has a 7% guarantee every year, how can I beat that? Here's the deal, guys. If fixed annuities currently have non-guaranteed first-year rates of no more than 4%, there is no way that anybody can price for a 7% guaranteed interest rate. We are not talking about a guaranteed annual return that's credited to the account value. We're talking about a guaranteed return on this invisible benefit-based value that only gets utilized or used if the client turns on that income. It's not the same thing as the interest rate on your CD, and that's so important to understand.
It is important. And, I can't remember, it was Monday or Tuesday show, but Cheryl went off the rails and made a statement that I thought was really huge, and I'd love to get the stat on that, especially third party, if I can get the authority on that.
She said that she read somewhere where somebody is going to live to 150. That person is born already.
Time Magazine, yeah.
Time Magazine. Somebody is already going to be 150. Now, she did also say, which I thought was a little theologically disconcerting, that somebody born today may live forever too. I mean,
within the next 20 years, they said, because of medical advancements.
Wow. I mean,
scary.
Can you see it? Steve, age 100. Centurion, still broadcasting live from Fountain Hills. You know, my boss is going to love that. Because I told him I'm retiring, you know, and he says, no way. Now I can do it. And I'm hoping that can they also not only make me live forever, but can they take care of the baby boomer jaws and the eyes and everything else? I'm looking into that all day long. But, you know, my reason I bring this in is because income annuity, or in your side, this income stream that'll generate, maybe not so much annuitization, that phrase, that is going to generate lifetime income. And if we have people, as I said on the show a couple shows back, my wife is like, she just eats right, works out, exercise. I mean, that woman's going to live till 100, no problem. I mean, you know. So when I see that, I mean, I put on joint income because the gals are going to outlive us by such a longer stretch. It seems like, at least, if stats still stay the same. And I mentioned on the show, and again, if you say, Steve, I want this stat, I do have the 2001 CSO that I'm willing to give away all day long. If you want to read the mind-numbing 2008 Society of Actuaries VBT valuation-based tables, I'm happy to give it to you, but I go out to their site and get it direct. It's a PDF that is like a dictionary. It's huge.
That's what I like to do in my fun time.
But if you really had a problem with sleep, that'd be the doc to read. But it's really great because you're going to see income. I think, this is just Steve out talking out loud, I think income riders are going to be huge for the surviving female spouse. If everything stays the same, I think it's going to be huge. And that money is going to be...
It's guaranteed.
Guaranteed and automatic. And that, to me, is going to be a huge selling point.
Well, and you know what amount your paycheck for life is on the day you sell it. You know, as long as you know when they're turning on that income. And I think this is a huge opportunity because you look at annuitization, it's a couple of thousand years old, okay? And we only have 2% of those who own annuities annuitizing. That's the whole value proposition. You can't guarantee that lifetime income without annuitizing unless on an index annuity you've got an income rider. This is huge, Steve. Today, GLWBs on index annuities are 6 years old as of this month. And we already have 12% of those who have an income rider on their index annuity actively taking income under the contract.
And look how...
So in 6 years, we've outbeat annuitization by more than quadruple, you know?
People are seeing this. I mean, the value proposition is huge at lifetime, and especially with, in my view, female on this number. It's going to be huge. She's going to get a lot of money well into her 90s. Now we're talking age 100. I can't even believe this. The Guinness Book of World Records, she died about, 7-8 years ago at 121. Wow. I mean, think about that. What were they eating and drinking? I don't know. Hey, when we come back, we're going to be talking about more and more of these income scenarios. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. You can email me at the show's address, thebiz@brokersalliance.com, or you can call 1-800-290-7226, extension 147. Sheryl and I will be right back after a word from our premier provider of products right after this break.
Life doesn't always fit into 5-year increments. That's the standard for most term insurance policies. AG Selected Term offers you a powerful new way to help your clients customize their life insurance plans to anticipate known future events such as retirement, paying off their mortgages, or funding their children's college education. Buy only the term you need and no more. That's AG Selected Term from American General Life Company and the United States Life Company in the City of New York. Policies not available in all states.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant, insurance columnist, syndicated insurance columnist, I might add, financial color commentator, and interviewer extraordinaire. Of course, before you move forward with anything we talk about, especially tax and so forth, talk to your CPA, your tax attorney, and if you're FINRA licensed, your broker-dealer compliance department. If you have any questions or quotes on life insurance, annuities, DI, LTC, or group pension plans, just call 1-800-290-7226, extension 147. It's not what I know, obviously. It's who I know, and that's why I have Sheryl Moore on our show. And Sheryl and I have been talking about index annuities. Last segment, first 3 days, we still got tomorrow to go, and we're focusing on income. income riders. Income riders to help you. I don't mean to be Dorsius here, but income riders to ride out the storm. Couldn't pass it up. Well, let's just talk about it. We're talking about income. And as you said, we're already triggering more income than most annuities who have it, like you said, like less than 2% do it from a historical point of view. I also noticed one thing, and I'm not going to say who this is on the air, but I noticed that everybody that went to the new 2001 CSO mortality tables, they ran to it on the life. But I think the annuitization rates, they didn't actually upgrade those. Some of those annuitization rates, in my view, are somewhat archaic in view of the mortality revolution. And I think some of the ones that we kind of know inside could be way better. Those numbers could be way better. So, I'm just saying, just heads up.
Well, that's true. And actually, in my work with the NAIC, I've seen that there are actually some carriers that are doing age setbacks on their annuitization tables. We don't see much of that in the fixed or index space.
Now, talk about that just for a second. What do you mean by age setbacks?
Well, when you go to activate your annuitization, maybe you're age 67, but the insurance company has a 7-year age setback, so they're going to say that you're actually age 60.
Now, why are they doing that?
Well, it has a lot to do with the living benefits that are offered on those products. But, there are a lot of different ways that you can, I don't want to say manipulate, but affect the amount that you're going to pay out, whether it be on annuitization or GLWBs.
I've looked at it. There's a couple index annuities out there, and I want you to speak to this because the one I saw was just unreal. Baby boomers, perfect for baby boomers too. Not only do they guarantee you the rate for the rest of your life on the phantom account and your money that you're going to get all the time, but the first 5 years they actually bump it up because there's a transition. And by the way, you got to think about this. You're ready to retire today, but maybe you're not ready to retire because you're used to a certain amount of money coming in. They actually bump up the actual rate of return you're going to get for the 5 years. Then it goes back down to its level, but you get a little bit better increase bump. Have you seen this yet?
On the roll-up, you mean?
On the roll-up, right.
Yeah. Well, and interestingly, I do have some companies that are out there marketing increasing income riders or having the potential to increase your guaranteed lifetime income payment based on the performance of the outside index. But I need for everybody to know that there's only so many pennies in the dollar. And yes, we have become commoditized in the index annuity market, and really the income riders are what has helped it to be not so much of a commodity. But you still need to understand that there's only so much money that you can use to price these benefits. And if there's this one guy that has this really attractive thing compared to everybody else, well, you can bet he's paying for it somewhere else. You know what I mean?
Oh, no, I do.
So on increasing income riders, for example, you might have a lower payout where traditionally at age 65, you might get 5% withdrawals for life. Maybe on that increasing income one, it's 4.5% withdrawals for life. And some of the folks who have the potential to increase the payment based off of the index's performance, well, you need to ask yourself, what do you think is the index going to do from here on out?
Okay, let's talk about that for a second, because now let's say I'm at my age, probably for me it'll be 70. Let's just say at age 70 I'm ready to retire now, and I want to turn my switch on. And I noticed, oh my goodness, I just had the actuaries just do the run. I know what I already got guaranteed. I already had that all along. But now I'm like, hey, I did pretty all right. I did okay, right? And it's actually more. Do I want to turn on the actual current company practice, the actual account value?
Oh yeah. Well,
but that could change though, because I'm still on the current consumption, right?
Well, you're saying annuitization versus turning on the income.
Well, I don't know. I want to know: am I turning on annuitization on my current account because it looks bigger than my guaranteed income stream?
You want me to drop a revolutionary statement that's going to be controversial on this segment?
Oh, clickability. The show's going to get clicks.
Annuitization will almost always provide a grayer payout than a GLWB. Almost always. But here's the difference. With annuitization, I lose flexibility.
Right.
Okay. My agent loses control of the money. So if my circumstances change 2 years from now, there's nothing he can do to help me. Okay. Also with annuitization, quite honestly, one of the biggest reasons we don't see more of it going on is it doesn't pay. It doesn't pay as compared to a deferred annuity. Now with the income rider, I don't lose my flexibility. So let's say I get in a car accident and I have to pay a $500 deductible, but my monthly payment's only $360 a month. I can actually say, hey, can you send me $860 this month? And I can do that with the income rider. You can't do that with annuitization.
Now, are they going to reconfigure the income because it took out more?
You will be penalized on that phantom benefit-based value, but you still have access to it.
So does the extra money come off the phantom number then?
Yes.
And then it recalibrates?
Right. And it differs depending on the carrier. Some people penalize dollar for dollar. Some people do it pro rata, and that's probably beyond the scope of the show, but you still have that flexibility, okay? And with annuitization, let's say I had this client call me once with the agent on the line, and she had locked up her money in a 2-tiered annuity, and she said, I knew that was right for me, and I knew that I had to defer for 5 years, and I had to take income for at least the next 10 years, and I was okay with that. But you know what happened? My daughter got divorced, and she's got 3 of my grandkids living with her, and now she needs help paying her monthly expenses, and I just didn't account for that. I don't have enough set aside in my savings and money market. How can I get access to this money? Well, in that situation, there's nothing she could do. And with annuitization, there would be nothing she could do, because that $360 payment you get every month, that's what you get till the day you die with annuitization. But with the guaranteed lifetime withdrawal benefit, she could take a penalty-free withdrawal, and she could increase her income amount through her income rider. She still has lots of options.
But again, it
will affect that benefit-based value.
That benefit-based value. And that, to me, that's important to know, because I want to be able to say that to the client. Now, there's going to be an adjustment here.
Yeah, absolutely.
And the number's going to go down. Okay, so just a heads up. Now, but I do like what you said. I like the flexibility, no doubt about that. And I do want to I want to be able to pivot, because life isn't an analog, timeline.
Right.
There's things that happen. Now, and also this brings up a whole nother scene. I mean, just what Sheryl said is, I'm thinking, now our generation, baby boomers, our parents are pretty much either ready to die or have died. They've already passed on the next generation. Now I'm looking back at my kids saying, oh my gosh, my kids are going to get divorced. They're going to move back in.
It's happening more than ever before.
Wow.
They call them boomerang kids.
Boomerang. Oh my gosh.
They come back.
I'm writing that down. Boomerang kids. Well, I just want you to know, I had one of my kids, and she had a little episode, and she said, Dad, I'd like to come home. And I said, I walked her out to the front door, and I showed her the actual address on front of my box. She goes, why are you showing me this number? I said, I just want you to know you don't live here anymore. Wow. It's not a compassion list, Steve Savant. It's, hey, I didn't make sure, I didn't really account for this. Now, that's going to be another issue. We've been on both sides of this. Boomers have been squeezed on both sides of the generation, no doubt about this. When I like the flexibility of an income, because I can dip in there for whatever emergency, right? Hopefully it's not my kids, right? I hope it's other things.
You don't even have to say what the emergency is.
So I don't have to qualify. Now, I like the idea when you say, if I was still raw data, and you remember, I have people out there that are math guys, math gals, who just say, hey, I'm not going to try to figure out every variable that life's going to throw me at. Give me the annuitization rate, because as you just said, we did the math, the annuitization almost every time beats a GLWB.
Right. You're essentially paying for that flexibility with the income rider. But another thing you have to keep in mind is, I can turn annuitization on whatever I want. Well, with an income rider, most companies have their minimum issue age for the rider as age 50. There are a couple that have age 40. And then we have some companies that actually have the income benefit embedded into their base policy, where it's not a, yeah, I want it, I'll take it, or no, I don't. It's not an electionable rider. It's built into the policy. Those have no minimum issue age, but by and large, the majority is minimum age 50. Well, it's not really smart to do that if you're using qualified money, because you're going to have a penalty for taking money out before age 59 and a half. But the annuitization does almost always provide a greater payout. But let's face it, Steve, how many people are talking to their clients about annuitization? When I first started hearing about income riders in the VA market, I said, look, I'm hearing all this information about these boomers and the trillions of dollars that they have accumulating, and everybody's worried about how are we going to transition that into an income stream. Well, guess what? We found a way. And I'm personally feeling like there's a light at the end of the tunnel, and people aren't going to have to worry about not having enough money when they retire, because most people don't even realize Social Security is only supposed to account for 40%. And I just saw an article that said, realistically speaking, now Social Security is only supposed to account for 30% of your income at retirement. So how are they going to supplement that gap? Well, the income rider on the index annuity is a viable alternative, so that now we can tell that income story.
Well, you just brought up another pain-filled topic, not only Social Security, and I don't have time to really get into that, but Social Security from the point, People are holding. I mean, that hold position in my age group specifically, if I hold to 67, I got this number. But if I'm willing to wait till 70 and a half, that number gets big.
Way bigger.
And I am very surprised. So when we say 40% to 30%, well, I don't know what age you're taking it out on, but if you can hold, and again, remember, I don't know if you can or not. Maybe you need the income, and maybe some of you have to take it as early as 62 when you have your first foot in the door to be able to take income. But if you can stall it to 70, and then you're turning the trigger on a lot of these indexes, you're going to have a nice income stream coming from Social Security as well as your index annuity. And tomorrow when we get into the show, I got to ask about qualified plans. We get into that debate all the time using index annuities, and that's going to be a thriller, I'm sure. Don't forget, you're going to watch this show tomorrow. We're going to talk about index annuities and qualified plans. We're going to do a redux a little bit about some of the high points of this week. You want to watch this show. If you're an index annuity producer, this is the show for you. Listen, you can watch our show in HD 1080p right on our website, www.brokersalliance.com. Just hit the on-demand video section. It's exactly what you want to see. And of course, all over our social networks, YouTube, Vimeo, Facebook, LinkedIn, and of course where I tweet, Twitter. Hey, this is Steve Savant. You've been watching the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone. The Business Insurance Zone. Ooh, nice lip sync.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.